because of all the monetary engineering that's been going on, such as lowering the interest rates, the government's able to do things such as raise or lower taxes, and the fact that we've pumped $2 trillion about into the economy already, and Biden's looking for another $4 trillion. I think we're about to go into a situation that's similar to the 1940s to 1975. Now, what happens at the end of it depends on whether or not we pump the brakes along the way. So what happened in the 1940s and 1970s is essentially we ended up in a wage price spiral where when you engineer things and you lower the interest rates and you do stuff like that, what happens is it increases the likelihood that somebody's going to go and spend money and take on debt or over leverage themselves. And when everybody is doing that, causes the prices of everything to go up, causes the prices of stocks to go up, bonds, real estate. So everything's going up. And now that everything's going up, well, you have to pay more in order to pay your rent, you have to pay more in order to pay your mortgage, you have to pay more in order to do this, do that. The cost of goods goes up. So in order for the consumers to be able to continue purchasing, then all of the companies say, okay, well, instead of passing on, the cost to the consumer, let's pass it on to, the person that's doing the labor. Let's just pay them more in order to keep things growing. So because they don't want to lower the price of their goods in order to get people to purchase more and more. So let's just pay everybody more. So they say, okay, we'll pay everybody another $1, another $2. And what's going on right now is we just went from, $12, $13 minimum wage in a lot of places up to $15. And so that's combined with the fact that we just pumped a bunch of money into the economy and lowered the interest rates. So there's a new basis that we have to hit. And it's causing the market right now, and all the markets, to essentially be very erratic because people are trying to figure out what that new kind of stable middle ground is. And there's a lot of speculation and emotions that are going on top of what that base number, that new number should be. So when they continue to raise the wages of the workers, okay, cool. Well, now people have more money, so they can buy more stuff. So they start to buy more stuff, which increases the output of these companies. And so the companies say, okay, cool, we'll pay the workers more. And it goes on and on and on. But what happens is you end up with what's called economic overheating. And so this is my little gauge. When the economy overheats, what you have is a combination of inflation and stagnation. Essentially, now that the amount of products and services that are available in the economy have maxed out, we're at 100% employment, and we're selling pretty much 100% of goods and services. Now you have a few issues. Now you need to increasingly pass the cost of inflation onto the consumer. So the prices of all the goods and services are still going up, but now the wages can't go up because there's nothing else to sell. So in order to keep on increasing these wages, well, we have to, increase the prices of all the products. But we're not making anything new, we're not making anything else, and it's becoming hyper inefficient because that whole time that, we had all the wealth in the 1940s to 70s, the US had 40% of the worldwide wealth. Now that we have all of this wealth, we're putting money in all of these inefficient spots. And so in comparison to the global marketplace, when China and Japan and all these other places start producing products for super cheap and super efficiently, and they can do things such as put an embargo on US trade and say, hey, we don't want to trade with you guys anymore because your prices are ridiculous, they're getting stupid expensive. Now you have the opposite effect. And so now that everything is overheated and it's all the way over here, all of a sudden everything starts crashing back down on top of itself. But so you have lower GDP, you have lower economic growth, and you can't you can't really stimulate it without getting stuck in a liquidity trap. And on top of that, nobody wants to buy our goods or services, and so now we have to start firing a bunch of people. And so what happened around 1973, 1974 is all of a sudden the unemployment rates shot up to it was like 9% or something like that. But over the period of those years before that, the prices of everything had shot up 17 to 20%. Now, aside from that, there are also some other negative effects of inflation, and the reason that we should tap the brakes by increasing mortgage rates, stuff like that. One reason is people that are on a fixed income, such as Social Security, pension, stuff like that, or if they're in a service or goods based business that isn't able to raise wages with the prices for some reason. Those people that are stuck on those fixed incomes, it's just the government's going to create a bunch of essentially, misery by having this inflation and by having some people generating a bunch of wealth on paper. And then, because, the prices of everything is going up, but they're not making any more. And what I mean by the liquidity trap is that essentially, if there's a lower band on the chart when you're looking at the data for this stuff, and so if you essentially lower the interest rates to zero and you start pumping some money into the economy, it becomes a situation where it's like, okay, well, now we can't lower interest rates anymore, and so we just need to keep on pumping money into the economy. But the more and more that they pump the money into the economy, all of a sudden it's not stimulating any more growth, because people all of a sudden, for some reason, would rather hold on to their cash than they would go spend it, because they start to fear that deflation is going to come. And so because they're making that emotional decision that they think it's going to come, then that is combined with the first part of what I was talking about, and that causes everything to come crashing down as well. Because if everybody sees, hey, the cryptocurrency market, real estate, all of this has shot up to, houses are $3 million. Now cryptocurrency, Bitcoin's 200 grand, all of this stuff, and they see things going too well, they become scared. And so even though the government is engineering and pumping a bunch of money into the economy, all of a sudden I'm less likely to spend. I'm just gonna, I'll hold on to my cash for a minute. I'm gonna wait till this drops down and I'm gonna buy the dip. But when you have that situation in combination with the overheating of the market and inflation running away, now all of a sudden you have nobody producing anything, prices of everything are crazy, everybody on fixed income is miserable, and just a million things that are not good. Now, they have some tools to stop this, and it might not be as bad as the 40s to 70s where it shoots up 17% in price, but the cost of goods just over, like, I think the past, the most recent update was like the increase was like 0.89%. So, it hasn't been that long since the start of COVID. So for it to already go up 1% in the cost of goods, that could be directly contributed to just the wages, but it's not. It's a combination of the engineering, the economic engineering, monetary policy engineering, all of that kind of stuff that's going on. So we're very likely, the economists say that there's a 1 in 4 chance we're going to see at least 1 year over the next few years where we break the inflation rate of 5%. Now, what the Federal Reserve and all of those guys' jobs are is to keep us around 2% to prevent all of these things that I'm talking about. But we're very likely going to see 3 to 5%. So if you own real assets such as real estate, you're very likely going to become extremely wealthy on paper over the next 5, 10, and this could go on for an extended period of time. It's very hard to tell. It could be 5 years, it could be 20 years. Nobody knows, because things can continue to spiral and get pushed out further and further. But the bad side of that is that people that are in fixed income are going to have issues, and everybody as a total at the end of that, because we've been, essentially pushed to take on larger and larger risks. Because if you're up in a, if housing prices in the Bay Area go up 40% over the next few years, everybody's going to want a house. So everybody's going to go and try to buy a house because they're going to have fear of missing out, and they don't know how long the prices are going to keep on going up. And what people don't realize is that everybody can be wrong at the same time in one direction. Now, I'm not saying that necessarily anything super bad is going to happen, but essentially the more that inflation gets out of control, it pretty much every single time ends up worse at the end, because we end up with, instead of having a 1 or 2% increase in unemployment and all of these other things, it ends up being a 5, 6, 7%, and then you need to keep on doing the monetary engineering in order to keep on preventing that from being an issue. But because you're making it so that people have more and more money and wealth on paper every time that happens, and they keep on spending money more and more inefficiently, but the global market may not be doing that, and they're creating prices and processes and manufacturing processes that are more efficient. It makes the nation as a whole more and more poor, and have a lower and lower quality of life. So yeah, let me know your guys' comments. Let me know your guys' opinion down in the comments, and that's about it. See you guys next time.